And that's your closing bell on this Wednesday, March 30th. We've got one more day left in the first quarter of 2022. And taking a look at how the major averages close out here on the day, the Dow Jones Industrial Average closes lower by about 0.2%, 66 points in the red there. You also see the S&P 500 there on your screen. That closed lower to about 0.6%, 29 points in the red. And then also the NASDAQ composite closed lower by 1.2%, 177 points in the red. And so with the major averages closing lower across the board there, also in the sector front, just breaking that down very briefly here, you only had 4 gainers: consumer staples, health, utilities, energy, really rounding out to the only gains. Outside of that, you had laggards led by consumer discretionary and technology and financials. And so for more, let's dive into our panel here post-close. Joining us is Sam Stovall, who is the CFRA Research Chief Investment Strategist, and John Maier, who is the Global X ETFs Chief Investment Officer. Great to have you both here with us today. Sam, I want to start things off with you. As I was mentioning a moment ago, we're a day away from the end of a first quarter where we all could have used some Dramamine. So help us make sense of how this sets up for Q2.
Well, if you use history as a guide, and I find that it's usually a pretty good guide, but not necessarily gospel. If you've been in the first quarter that has been among the worst 15 since World War II, which is where we are right now, indications are that we have a good chance of seeing a positive second quarter where the average price change was close to 5%, and we were up about 2 out of every 3 years. So whatever decline we had in the first quarter tends to be recovered in the second quarter, but we'll wait and see if that holds true.
John, the same to you. What are your expectations for Q2?
Well, I mean, if you look at today's action, oil prices are back up. Energy market swings appear to be driving the equity markets. And it really depends on how long these higher prices persist. Higher oil prices could be a bearish signal for the overall market, even though it's boosting energy prices, as certainly today. The market has been fairly resilient in light of a war and high inflation. And that being said, over the next quarter, what we believe that because of the Fed tightening cycle, in terms of positioning, investors should be insulated by owning profitable companies that pay healthy dividends and are less reliant on capital markets owing to higher interest rates. But I also think they should be exposed and be positioned in certain areas that are going to be key beneficiaries of the current situation, be it cybersecurity. There's going to be a lot of additional spending in the cybersecurity space. Robotics. If you looked at the jobs report today, the job market's really tight. So efficiency is really key. And commodities, either through MLPs or uranium. So that would be how I would be positioned for the next quarter going forward.
And Sam, as you look at some of the fundamentals in the US economy and what they're signaling versus what we can expect in terms of the impact from the Fed, obviously some hints of recession as we also look at the yield curve, how are you positioning your investments?
Well, I'm coming to the realization, obviously, that history again repeats, because when you look to the correlation between the yield on the 10-year note and the PE on the S&P 500, we traditionally see PE contraction take place. And I believe that was the case for this quarter when we had the S&P down 13%. We had a PE ratio that went down into the 19s for the next 12 months. But unfortunately, we're back up to about 21 or so. And so I feel as if the market is getting a bit vulnerable once again. We're looking for first quarter earnings to come in at around 5%. But I think investors are hoping that we get some sort of an upward surprise despite the negative news heading into it.
John, just to follow up on that, on the PE side, what do you expect to hear from companies as they get ready to report not just their results for this most recent quarter, but also their outlook going forward from here, and how that also dovetails into some of the forward PE that people like yourself are going to be calculating?
Yeah, I think you had it right in terms of the guidance. I think the guidance is going to be key. What we do know is that there's a lot of concerns out there. There's inflation. There's supply chains, and there's a war in Russia and Ukraine. And how is that going to impact the supply chains going forward? So I'm paying close attention to what companies are saying about in terms of their guidance. I do think that growth will weaken. There's certainly higher prices. That's of no great surprise. But there are positive spots that are very strong. The jobs market is very strong, and the consumer is fairly healthy, although there are some early signs that there's some deterioration with higher credit balances for the consumer. So the consumer is also going to be key, and I'm going to be listening for that on many of the calls.
Sam, interestingly enough, the word booming is trending on Twitter because MSNBC tweeted that the Biden's approval rating is at an all-time low despite a booming economy. Given everything John just said there, we've got inflation, supply chain issues, a very healthy labor market. Is this 30,000 feet a booming economy?
Well, if it is, I am not happy to hear that word, because usually you end up with a word like that then precedes a sharp decline in economic growth, et cetera. By the time it reaches the greatest multiple is usually the time in which we end up seeing a peak. So I am concerned because our economics group just reduced the first quarter estimate from 1.3% down to 0%. So it looks as if we're not going to have any growth in GDP in the first quarter. That obviously could adversely affect what we hear in first quarter earnings. And as John just mentioned, if we have prolonged high oil prices, the old rule of thumb is that it takes off 20 basis points of real GDP over time. So we do have a lot of headwinds that we will have to resolve.
So John, then for retail investors out there who are wondering, do I hold on to my cash or where should I be putting my investments? What would you tell them in terms of not panicking and really keeping an eye on the fundamentals that you're watching in the markets?
Yeah, I think that the key is to not panic and to position properly, certainly on the edges. I mentioned earlier that I think investors should have a healthy exposure to profitable companies that are less reliant on the capital markets, because we do know that the Fed is increasing short-term rates. I think it's highly possible that in May and June, you'll see 50 basis point increase in short-term rates at both meetings. The Fed needs to keep inflation under control. That is of great importance. That being said, there are certain trends that are undeniable. Cybersecurity is an area that I think should be in many people's portfolios. Cybersecurity spending is expected to increase significantly, especially with the digitization as well as the threat of warfare. So companies are increasing their cybersecurity spending, so that's going to certainly benefit cybersecurity companies. And also having exposure to commodities, particularly in light of what's going on right now. We feel through MLPs, receiving both a high yield as well as a correlation to commodity prices as well as rising interest rates would be beneficial to a portfolio.
John, just to follow on that, are you suggesting ETFs, cybersecurity ETFs, HACK or CIBR as two of the most popular ones that are out there, or are you picking winners and losers, individual names?
So, we have a cybersecurity ETF. The ticker is BUG. It's a broad-based exposure within the cybersecurity space with high revenues exposures to cybersecurity. So I think investing in an ETF makes a lot of sense because you're not necessarily picking that one winner. You're getting a broad exposure to a lot of different companies. I think that's really important.
All right, Sam Stovall, John Maier, appreciate you both being here.